Last year, I was at a Christmas party when someone heard I was a financial advisor. This gentleman brought up how much money he'd made owning several individual stocks, including Nvidia. I said, "Hey, I love it. And how does your performance compare to the overall stock market?" I was asking him about his overall returns, including the potential losers. He kind of turned his head. He was unsure. Here's the first smart thing he did. He admitted he didn't know. Here's the second smart thing he did. He pulled up his account on his phone and we looked at it together. We found that his returns were 8% per year, while the overall stock market had returned 10% per year. Now that was a light bulb moment for him. He realized even though he was making good money, he could have made more money using a simpler approach. And he could have saved tons of time and effort by not picking individual stocks. That's why this topic is important. So let's jump into what you need to know and how you can apply it in your portfolio. There are two main philosophies when it comes to stock investing. I'm going to explain the basics of both, their pros and cons, and the one I strongly prefer when helping my retiree clients and for my own retirement portfolio. At the end, I'll share some real-world examples. And this applies to anyone who's investing in stocks, whether you're in retirement or you're just starting out with your 401k. The first philosophy is called index investing. That just means owning a little bit of all stocks and keeping your fees ultra low, about $300 for every $1 million you have invested. And investors who've used this philosophy have earned 10% annual returns for the past 60 years. That's the high-level summary. I'm going to come back to this in just a couple minutes. The second philosophy is called concentrated investing. This just means trying to outperform index investors by owning a smaller group of stocks with more money going in each one, hence the term concentrated. So to do that, investors either pick individual stocks themselves or select mutual funds that pick individual stocks for a higher fee. Now, here's a fact worth remembering. According to Standard & Poor's, over the past 20 years, 94% of professional money managers using concentrated investing have failed to outperform index investors, just like the guy in the story. That means that only 6% have succeeded. And here's the startling fact that very few people know. On average, the 6% of managers that outperformed added just an extra 0.6% of after-tax return per year, meaning that if the average return was 10%, they delivered 10.6% per year. And on average, the 94% of managers that underperformed did so by a wealth-destroying 4.8% per year, meaning that if, again, the average return was 10% per year, they delivered just 5.2% per year. That's a massive gap. So based on the last 20 years, concentrated investing on average offers a small chance of doing slightly better than average. And on the other hand, it offers a high chance of seriously underperforming. In my professional opinion, that may not be an ideal setup with your retirement savings on the line. So why do people do it? There are opportunities for amazing returns. There really are. Nvidia, Apple, Google, names like that have produced massive returns in the past, and that's easy to get excited about. It's easy to chase after. That's also why people brag about them at parties. What they're not sharing is how many losers they picked or how they've done with their entire stock portfolio compared to the overall stock market. So, concentrated investing has its pros and cons. What's the alternative? It's the one I strongly prefer for my own retirement account and for my retiree clients. That's index investing. So what does that actually mean? It just means owning a little bit of all stocks. So how do you do it? The answer is owning an index fund. So let's break that down. The word index just means list. So an index fund is just an investment that owns a list of stocks. As an example, you've probably heard of the S&P 500. That's a list of 500 of America's largest companies. And there are index funds that just track the S&P 500. Many people aren't aware that owning index funds could be a great way to earn better returns with stocks because it makes you an owner of some of America's best companies, allowing their gains to be your gains. while also minimizing your fees. As I mentioned before, index funds charge about $300 per year for every $1 million that you have invested. Cost-wise, that's about as good as it gets. Now you might ask, what do the returns look like for index funds? Over the past 60 years, broad U.S. index funds have returned about 10% per year, with dividends being reinvested. Now that rate doubles your money every 7 years, or roughly. Now it's a surprise to most people that $100,000 invested in index funds in 1964 is worth $30 million in 2024. That doesn't mean that same thing's going to happen over the next 60 years. And in my professional opinion, future returns will be lower than the 10% we've seen in the past. So what's the downside of index investing? Well, it can be boring. It's not as exciting to tell your friends at that party that your index fund returned 10% when your friend is talking about their 800% returns on Nvidia. But do you know who doesn't care about indexing being boring? The world's most successful stock picker. When Warren Buffett passes away, 90% of his estate is going into index funds for the benefit of his wife. Here's what he had to say to CNBC about index funds. The trick is not to pick the right company. The trick is essentially to buy all the big companies through the S&P 500 and to do it consistently. Okay, to make this as helpful as possible for you, I'm going to share some real-world examples of index funds. But first, a quick disclaimer. Index funds can drop by 50% or more in a given month or a given year. They have before, they will again. All investments carry risk, including the risk of principal loss. What I'm sharing today is purely educational. It's not a recommendation to buy or sell any investment. So please just do your own due diligence before investing. With that said, index funds are available at any major brokerage firm and most 401ks. Here's 3 simple things to look for. First, look for the word index in the name. An example would be Total Stock Market Index Fund. Second, check that the fund has high diversification, at least several hundred stocks inside of it. It could be thousands. A total stock market index fund will have roughly 4,000 stocks inside of it. Third, check that a fund has low fees. Look for a figure called net expense ratio, which describes the fees you pay every year as a percentage of your investment. That term is really worth remembering because it applies to every fund in the universe. For an index fund, you can expect that number to be about 0.1% or lower. Okay, here are 3 real-world examples of a total stock market index fund. Vanguard has a symbol VTSAX. Schwab has a symbol SWTSX. Fidelity has a symbol FSKAX. All of these funds are doing the same thing, and they own essentially the same stock holdings. The name Vanguard or Schwab or Fidelity does not matter. And if you want to buy an index fund, they don't need to be any of those exact symbols I mentioned. There are dozens of other ones essentially doing the same thing. If you're unsure about what index fund is available for you, you can call your brokerage firm or your 401k provider, ask them for help in finding an available index fund. They'll give you that help for free. I know because I used to do that when I worked for Charles Schwab. Now, here's the last bit of help I want you to keep in mind. An index fund can either be a mutual fund or an exchange-traded fund, also called an ETF. A mutual fund and an ETF are both just baskets, and they can hold anything. Here's what you need to know. If you're going to buy an index fund in a taxable brokerage account, in other words, not a retirement account, I would strongly consider buying it as an ETF rather than a mutual fund, and that's for tax reasons. The technical details here are not crucial. Just know that ETFs have an advantage over mutual funds inside of a taxable account because of how they trade. If you're buying an index fund in a retirement account, it's fine to buy it as a mutual fund because the tax side does not matter, and often a mutual fund is your only option. Just so that you don't confuse the two, know that mutual fund symbols always have 5 letters in the name, and they end with an X. ETF symbols have either 3 or 4 letters, and they may not end in an X. Now, here are 2 quick examples of an index ETF. Vanguard has one called ticker symbol VTI. Schwab has one, ticker symbol SCHB. Okay, I hope this video was helpful in terms of improving your future stock returns. If you did find it helpful, please share it with someone else who might benefit. And before you go, please post your retirement investing or planning questions in the comment section below. I'll answer them in our upcoming podcasts. In our next video, we'll look at how to make your portfolio retirement ready using this philosophy on the stock side of your portfolio. Our goal is to help you maintain your lifestyle and retirement regardless of what's happening in the stock market or the rest of the world. As always, remember to dream big. Know that you can have the retirement you want if you plan for it. I'm Jonathan Bird, founder of Farnam Financial. If you're nearing retirement or in it and you want to learn how we can help you, please visit us at farnamfinancial.com. Thanks.